Welcome to the Byte-Size Brief. Today we are putting NKE, that's NKE, completely under the microscope. Let's get into it. Imagine walking into your favorite local running store, right?
Yeah, just a normal weekend errand.
Exactly. You're gearing up for a half marathon, you walk over to the shoe wall, and you realize something completely surreal.
Yeah.
The world's biggest sportswear brand is, virtually missing from the shelves.
Which is wild to even think about.
It's insane. If you told anyone that scenario 5 years ago, they would have laughed you out of the room. It sounded impossible. Yet today, that exact strategic reality is just one of the massive fires pushing NKE's stock to an 11-year low.
It really is a fascinating moment in corporate history. Welcome to this deep dive, listeners.
So to set the stage for you all, the company just released its Q3 2026 earnings, wrapping up on February 28, 2026. Right now, they're navigating what management is calling the middle innings of a massive turnaround under CEO Elliott Hill.
And a turnaround of this magnitude for a global giant with a market cap sitting around $78 billion is honestly like trying to parallel park a cruise ship.
Right, that doesn't happen overnight.
Not at all. It requires immense operational restructuring, shifting consumer psychology, and above all, time.
Which is exactly our mission today. We're looking past the headlines to figure out if this recent financial turbulence is just, a temporary stumble while they right the ship, or if there's a fundamental structural crack in the brand's foundation.
Okay, so compared to last quarter, what actually moved the needle here?
Well, the raw numbers are...
Because I'm looking at these raw numbers, and it seems like a mixed bag. I mean, revenue came in at $11.28 billion. That is totally flat year over year. But technically, it was a slight beat against the $11.23 billion estimate.
Right, a slight beat.
And earnings per share hit 35 cents, beating the 30-cent estimate. Wall Street loves a beat. They do. Wall Street loves a beat, yes. But we have to understand the mechanics of how that beat was engineered. Management and analysts, they aggressively lowered the bar leading up to this quarter.
So it was an easy jump.
Exactly. Stepping over a lowered hurdle doesn't mean you are jumping higher. You have to look at the absolute profitability, and that's where the reality check hits hard. Net income actually dropped 35% down to $500 million.
Hold on, how did that make sense? You just told me they beat earnings expectations. How can you beat Wall Street's EPS estimates but still drop your actual net income by a third?
Because the estimates were braced for an even worse disaster. The primary mechanism driving that massive drop in profit is their gross margin. It contracted by 130 basis points down to 40.2%.
Okay, let's translate that for the listeners. 130 basis points sounds like, financial jargon.
Think of it this way. For every $100 NKE brings in from selling shoes and apparel, they are keeping $1.30 less in gross profit than they did before.
Wow, just straight off the top.
Yes. And when you multiply that tiny margin leak across $11 billion in quarterly revenue, hundreds of millions of dollars in profit just evaporate.
And what is actually vaporizing that money?
Yeah.
Is it the cost of materials going up?
The heaviest anchor on their margins right now is severe North American tariffs. Supply chains are physical, rigid things. If the cost to import a shoe suddenly spikes because of a new tariff, you basically have two choices.
You raise the price or eat the cost.
Right. You can pass that cost on to the consumer, which risks killing consumer demand entirely, or you eat the cost yourself. Right now, NKE is eating a massive portion of it, which is just crushing that gross margin.
Plus, I saw they took a $230 million severance charge this quarter. They're cutting 775 jobs, primarily by automating their U.S. distribution centers in places like Tennessee and Mississippi.
Yeah, that's a huge upfront cost.
Right, which mechanically means they are spending a fortune right now on robotics and automated sorting systems to hopefully bleed less money on logistics in the future.
Correct. But to be fair, the balance sheet wasn't entirely red flags. The most critical operational metric for a physical goods retailer is inventory, and NKE finally saw their inventory levels stabilize. They dropped 1% down to $7.5 billion.
Which is actually a massive relief. For the past year, they've just been sitting on a mountain of unsold, stale product.
It is vital. Think about the physics of a warehouse. If your distribution centers are stuffed to the ceiling with old, out-of-trend sneakers, you physically cannot bring in the new, innovative product.
The stuff that actually drives excitement.
Exactly. The product that commands full retail price. When you're jammed up, you are forced to aggressively put those old shoes on clearance just to clear shelf space, and that discounting is an absolute margin killer.
So flushing the pipes is a good thing.
A very good thing. The fact that inventory is dropping, combined with North American revenue showing a 3% growth, proves that they are finally flushing those pipes.
But If they are flushing the pipes and North America grew, why did the stock absolutely whipsaw? I mean, I watched this happen live. The stock popped over 3% in aftermarket trading because the algorithms saw the earnings beat, and then it just plunged nearly 10% pre-market. It gives retail investors complete whiplash.
Well, the market is brutally forward-looking. Investors digested the slight beat today, but then they listened to the actual earnings call.
The guidance.
Right. Management provided week forward guidance stating that revenue will likely decline in the low single digits through the entire calendar year of 2026. So the market immediately priced in another 9 months of shrinkage.
Wait, so if their warehouses are finally clearing out, but management is still warning about revenue drops, there's a missing piece here. They must be struggling to get people to buy the new stuff. What is the actual hook to get athletes back to paying premium prices?
That is the core of CEO Elliott Hill's Win Now strategy. They are orchestrating a massive pivot away from lifestyle and back to a sport offense.
Because they got way too comfortable with streetwear.
Right. Exactly. Over the last few years, NKE got addicted to the easy money of casual streetwear. They just kept re-releasing retro lifestyle shoes, endless colorways of Dunks and Air Force Ones.
Yeah, I see them everywhere.
But while they were printing money on retro fashion, they completely lost their edge in the actual performance lab.
And performance is what built the house. I mean, if you're listening right now, you're probably wondering what sport offense actually looks like. I've been reading up on their new R&D rollouts, and it is bordering on sci-fi. Have you looked at the mechanics of this new Nike Mind platform?
The Mind 001 and 002 releases. It's a very aggressive leap into what they are terming mind science.
It's totally wild. They aren't just adding more foam or making the shoe lighter. They are blending neuroscience with footwear.
It's a very unique approach.
Yeah, the insoles of these shoes are specifically engineered with textured sensory-stimulating nodes that target the mechanoreceptors in the plantar fascia, basically the bottom of your foot. And by actively stimulating those nerves, it increases proprioceptive feedback to the athlete's brain, which supposedly alters their neural state and enhances actual cognitive focus during training.
It is a brilliant pivot from a marketing perspective, honestly, because it taps directly into the massive high-margin consumer shift toward health, wellness, and neurological recovery tech. They are trying to own the athlete's brain, not just their stride.
And the demand is insane. I mean, the secondary market is treating it like pure gold. It sold out instantly across every single geography, and it generated a wait list of 2 million people hitting Notify Me.
That's a lot of pent-up demand.
And it's not just the neuroscience stuff. They did a limited drop of the Air Max 1000, which is entirely 3D printed.
Which is a crucial manufacturing flex. Traditional shoe manufacturing requires carving steel molds, which takes months of lead time and locks you into a design.
Very rigid.
Extremely. With 3D printing, they can alter a shoe's geometry in software in the morning and print a physical prototype by the afternoon. It completely bypasses the traditional supply chain lag.
Exactly. Plus, they are creating massive cultural hype in Asia with the Unleashed Year of the Horse collection. And on the apparel side, they rolled out this Aerofit cooling tech for their football kits.
The dynamic material engineering.
Yeah. The fabric structure literally mechanically opens up as the athlete sweats, increasing airflow by 200%.
The Aerofit is actually the most strategic piece of everything you just mentioned because it is scalable. A 3D printed shoe or a neuroscience concept shoe is fantastic for brand heat, but it is a highly limited release. It's a halo product.
Right, it gets the headlines.
But it doesn't pay the dividend by itself. But Aerofit, they can debut that on professional pitches this year, and within 18 months, that exact same cooling technology trickles down into the everyday running shirts sold at your local mall.
So basically, it's kind of like they're transitioning from just a fashion brand relying on old retro styles back to a high-tech sports lab.
In theory, yes. But here is the friction point. Innovation takes time to scale. All of these high-tech drops are a tiny fraction of their total revenue pie today.
That makes sense.
Meanwhile, those legacy classic franchises we talked about, the millions of pairs of Dunks and Air Force Ones they overproduced, are acting as a massive financial anchor. They are still heavily discounting that old inventory.
Oh, wow.
So you have a situation where a sold-out, high-margin concept shoe is being completely offset by the fact that they are liquidating basic sneakers at 30% off just to get rid of them.
That's a tough spot to be in.
But they do have the ultimate accelerant coming up. The 2026 FIFA World Cup is happening right here in North America. They are already teasing new mercurial boots and national team kits. If you need a global stage to prove your R&D lab is back, you cannot ask for a bigger megaphone than a World Cup on your home turf.
It is the ultimate marketing catalyst. They will be presenting their brand in over 5,000 global doors simultaneously. However, even the best marketing in the world cannot fix a broken point of sale.
Right.
Which brings us to the structural roadblocks. If the innovation pipeline is churning out 3D printed shoes and the North American market is already showing growth, why is management still bracing for a revenue decline? Yeah, let's get into the weeds on the strategic fires, starting with what has to be the most spectacular, unforced error of the last decade, the disastrous push into direct-to-consumer, or DTC.
Under the previous regime, management became obsessed with owning the entire customer relationship and capturing double margins. They systematically severed ties with thousands of vital wholesale partners.
From massive sporting goods chains all the way down to local independent running shops.
Exactly.
Let's break down the mechanics of why that backfired so badly. By pulling their shoes from local running stores to force people to download the NKE app, they basically paid for their competitors' marketing. They voluntarily emptied the most valuable real estate in the store, and competitor brands like On and Hoka just moved right in rent-free.
Right, but what does all that actually mean for NKE investors?
Good catch. Let's keep our eyes on the ticker. For NKE investors, the company is now undertaking a very expensive, very humbling apology tour. They are crawling back to wholesale.
And the data shows it's slowly working.
It is. Wholesale revenue actually grew 5% globally this past quarter, and it jumped a massive 11% in North America. They are fighting tooth and nail to reclaim the physical shelf space they threw away. So basically, it's kind of like they built an exclusive, premium walled garden, but forgot that the everyday consumer actually likes shopping around at the mall.
That is a perfect way to put it. It is a painful correction, but absolutely necessary. Rebuilding those relationships will take concessions, which again puts pressure on margins. However, the wholesale mess is fixable. The situation in China is a fundamentally different beast.
The China crisis is brutal right now. Greater China revenue fell 7% this quarter, down to $1.62 billion. And listeners, this is not a one-off blip. This marks the 7th consecutive quarterly decline in a region that used to be their unstoppable growth engine.
Historically, Greater China accounted for roughly 15% of global revenue and an outsized portion of their profit growth. But the entire geopolitical and consumer landscape has shifted underneath their feet. They are rapidly bleeding market share to local competitors like Ante and Lining.
Let's explain why that's happening. Because it's not just that the local shoes are cheaper. It is a massive cultural shift driven by the Guoqiao trend.
Yes, Guoqiao.
Mechanically, Guoqiao translates to national trend, or China chic. It is a surging wave of domestic pride, where younger Chinese consumers actively prefer brands that integrate traditional Chinese culture and design elements.
And those local brands operate with a level of agility that a global behemoth in Portland simply cannot match. Ante and Lining have hyper-localized supply chains.
They move so fast.
Exactly. They can spot a micro-trend on Chinese social media on a Monday, design a prototype by Wednesday, manufacture it locally, and have it sitting on store shelves in Shanghai within weeks.
While NKE is still navigating like an 18-month global product creation cycle, by the time NKE's product hits the Chinese market, the trend is completely dead. So NKE's top-down, one-size-fits-all global approach just feels incredibly rigid and out of touch to the modern Chinese consumer.
Which triggers the exact same downward spiral we discussed earlier. When the product doesn't resonate, it sits on the shelf. When it sits on the shelf, you have to discount it. And when you discount a premium brand in a luxury-conscious market like China, you permanently damage the brand's prestige.
It's a vicious cycle.
It is. And adding fuel to this fire is the sheer logistical nightmare of the tariffs we touched on earlier.
You mentioned the tariffs are squeezing margins, but what are the actual dollar figures we are looking at?
Management is currently facing between $1.0 billion to $1.5 billion in annual tariff impacts.
$1.5 billion.
Yeah.
Just vanishing.
It is a staggering operational tax. To mitigate it, they are having to rip up and rewire their entire global supply chain, physically moving manufacturing hubs and logistics routes to avoid the heaviest tariff zones. You cannot do that overnight.
Hold on, how does that actually affect NKE's stock price for regular investors like me? With the PE this low, is this a generational dip buy, or are we just catching a falling knife?
That is the multi-billion-dollar question every portfolio manager is asking right now. Let's look at the mechanics of that valuation. Historically, NKE traded at an elite luxury tier premium. Back in 2021, the price-to-earnings ratio was soaring over 40.
Okay.
Today, that valuation multiple has been slashed nearly in half, sitting around 24.4.
Which means, mechanically, investors are only willing to pay $24 for every $1 of NKE's earnings today, whereas they used to happily pay $40.
Yeah.
The market has completely stripped away their invincible growth premium and is pricing them like a mature, struggling apparel company.
That's right.
But a 24 PE for a brand with the global recognition of NKE feels like it has to be a floor, right? I mean, look at what the insiders are doing.
Insider activity is definitely sending mixed signals. Over the last 5 years, the stock has surrendered over 40% of its value, and we have seen a lot of longtime insiders quietly selling off shares.
But then you have Apple CEO Tim Cook. He's the lead independent director on NKE's board, and he recently stepped in and bought 50,000 shares on the open market.
That's significant.
That is a nearly $3 million personal purchase. You don't drop $3 million of your own money into a stock unless you look at the internal data and see a massive rebound coming.
A purchase of that size by a boardroom insider of Cook's caliber is certainly a bullish data point, and it aligns with a specific timeline management teased on the earnings call. They explicitly guided that Q1 of fiscal 2027 should be the final quarter, where these elevated tariffs act as a material year-over-year headwind.
So we finally have a date circled on the calendar. Once they laugh that brutal quarter, the comparative math gets easier. If the tariff pressure eases, the supply chain restructuring takes hold, and the 2026 World Cup hype kicks in, we could theoretically see those gross margins violently expand back upwards.
Theoretically being the operative word. We have to be brutally realistic about the physics of a retail turnaround. CEO Elliott Hill was very clear when he told investors this will, quote, take a while.
It's not a quick fix.
Not at all. This is not a software as a service company where you can push a code update overnight and instantly improve your user metrics. This is a physical product cycle. You have to forecast a trend, engineer the fabrics, manufacture the shoes in Asia, load them onto cargo ships, distribute them across thousands of global partners, and then convince a consumer to part with $180 instead of buying a competitor's shoe.
It takes seasons to turn the ship, not weeks.
Precisely. From a pure investment analysis standpoint, the current stock price only offers true upside if the company can definitively prove two things over the next 12 months.
And those are?
Number one, they must prove they can actually expand their gross margins by scaling that new neuroscience and 3D printing tech into everyday products that sell at full retail price. And number two, they have to stop the market share bleeding in China. If guochao is a permanent cultural shift rather than a passing trend, NKE's historical growth model is fundamentally broken.
Which leaves us looking at an incredible duality. On one side of the coin, you have a company that is undeniably waking up. They're returning to their R&D roots, building literal mind-enhancing shoes, fixing their wholesale relationships, and gearing up to absolutely blanket the North American continent for the 2026 World Cup.
And on the other side of the coin, they are a company fighting deep structural fires, battling billion-dollar supply chain tariffs, and facing a Chinese consumer base that is actively prioritizing agile, culturally attuned, local brands over Western giants.
It leaves us with one final provocative scenario to mull over. Let's say Elliott Hill's win-now strategy executes perfectly in the West. Let's say NKE dominates the World Cup. The Aerofit tech becomes the industry standard, and they decisively reclaim their shelf space from the newer upstarts in North America and Europe.
A best-case scenario for the West.
Exactly. But what if the Chinese consumer never comes back? If the guochao movement permanently locks Western apparel brands out of that hyper-growth, premium luxury market, even if NKE wins everywhere else, can the stock ever mathematically return to those historic peak valuations without the Chinese growth engine?
It is the ultimate real-time stress test of how we value global consumer brands in a fragmented world.
All right, listeners, what's your take on the future of NKE? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on The Deep Dive.